Hey everyone, welcome to the webinar. We're going to go ahead and get started. Looks like we got a lot of people on and ready to go. Before we get into anything, if you haven't attended our intro webinar, Intro to Infinite Banking, then you're going to want to go ahead and make sure you sign up for that, because that is going to fill in a lot of the foundational principles behind what we're talking about today. And today's strategy is what most people are very interested in. It's known as a lot of different things. A lot of people call it infinite banking, bank on yourself, private reserve strategy. But that's what we're going to be talking about, a more in-depth analysis or the nuts and bolts of this private banking strategy. Now, before we get into anything, make sure you put in your comments and questions in the box below. That way we can answer those as we go and certainly at the end. But the private, as we go through here, I'm going to refer to this. I'm going to refer to something as a private reserve account. Basically, an account that is our private reserve. It's kind of a generic account that we have, and kind of like what we talk about in our intro webinar. We're going to be talking very, very much so about the principles behind this strategy and how this strategy works, what we're looking for, what it takes to accomplish it, and then kind of like the golfer, having the swing versus having the clubs. We're going to talk about the swing or the process of creating this private bank or this private banking strategy, and then we'll talk about maybe the different ways of implementing that, what products might fit that. There are multiple that could potentially fit. We're going to talk about the reasons why one versus another would be better or not. So that's how we're going to go into it. But again, comments and questions, make sure we get those. So to get going, to kind of define this strategy, it's a strategy designed to help develop or improve your financial situation by avoiding or minimizing unnecessary wealth transfers where possible. Now, we talked about wealth transfers in our last webinar, and we'll talk about those in that intro webinar, so make sure you check that out. But a wealth transfer really is money that you lose either unnecessarily or unknowingly. If you pay an unnecessary tax, you lose that tax dollar, and you also lose what that tax dollar could be worth had you invested it somewhere else. So it's the cost and the opportunity cost of money that is lost unnecessarily or unknowingly. But the strategy is designed to avoid those wealth transfers, to accumulate an increasing pool of money, and to provide control, accessibility, and uninterrupted compounding. A fundamental key to the private reserve account is that money must be accessible through collateralization. So we're going to explain a little bit more about what that means. But ultimately, the strategy is to put you in control and to do so while allowing your money to be working at its most efficiently. Okay, so this is what we call your personal economic flow model. And I want to draw your attention to this tank here on the left. It's called your lifetime capital potential. What this means is that during your lifetime, you're going to earn income, you're going to receive inheritances and other sources of income. It's ultimately what your value is, or how much wealth and income potential that you have over your lifetime. So let's take an example of someone that makes $102,000 a year, is 42 years old, and we're going to look at their wealth and income potential at age 65, or up until age 65. We're going to assume that $102,000 income grows at 3% every year, and that they currently have $88,000 in savings. We're going to assume that the potential for investment return is 5%. So when this 42-year-old turns 65, they'll have the potential to earn $3.3 million. If they could take that $3 million and invest it, as opposed to spending it anyway, meaning if every dollar were to be able to be invested at that 5%, their total wealth potential would be $6.1 million. We obviously know we can't go through life without spending money, but this is the total potential, and we're going to start looking at how that potential becomes less and less and ultimately is eroded as time goes on. The goal would be, obviously, to maximize that lifetime capital potential and have the most we possibly could at that future time. Once money is earned, it exits in the form of monthly cash flow. What you'll notice is that there's an immediate loss there. We call it your tax loss. Any dollar earned is going to have taxation to some degree or another. It's an immediate loss. After that, you have a choice. Is that money going to go to your current lifestyle, or are you going to push it up this tube and save it for your future lifestyle? Keep in mind, any dollars that are allocated to your current lifestyle are going to flow out and be consumed and gone forever. So if it's not saved, it's going to be consumed. Now, we like to illustrate that going up because it's a little bit of work. Pushing it up the tube is a little bit harder than letting it flow out, and that is exactly how it is with your savings dollars. To save money takes work. Now, as you save those dollars, you have a choice. Where are those dollars going to go? Are you going to put it in a savings tank or in an investment tank? Now, there's a couple things to note here with the differences in these two tanks. The savings tank, you'll notice, has a cap. That's for a very important reason. It's safe. It will not lose money. The investment tank, on the other hand, does not. So money that flows into that tank could potentially be lost or decreased substantially. Now, there are a couple ways that you could potentially deplete your savings tank. Number one is transferring money from your savings to your investments. And number two is to open this valve and use those dollars today in your current lifestyle. The amount you have in the future is going to depend on how you use those dollars. Now, I want to draw your attention down to this lifestyle regulator. Throughout your lifetime, and in this particular example, we saw that the income was $3.3 million. Now, all that could be consumed in your current lifestyle, or you could divert that into your future lifestyle. And the lifestyle regulator is really a regulation of how much goes where. Not enough pushed to your future lifestyle means that you're going to have to live on less in the future. And not enough today means you're going to have to live on a lot less now. So there's definitely a balance there. Now let's talk a little bit more about your current lifestyle. Your current lifestyle is composed of a lot of different expenses. There's phones, gas, clothing, utilities. But what you'll notice in this list is that there are some bold items such as cars, education costs, and weddings. Those are what we call major capital purchases. Now, a major capital purchase is essentially this: a purchase that cannot be paid for in full from your monthly cash flow. Your phone bill can probably be paid from your monthly cash flow. But a purchase for a car or a wedding or education, those are purchases that have to be either saved for or borrowed for in order to acquire the vehicle or those other purchases. So that being said, that gives you a couple options. You can leverage this lifetime capital. You can leverage those future dollars to purchase that major purchase today, or you can drain these accounts in order to fund or purchase that today. If you drain it, it means that you'll have to replenish it in order to have those dollars back for the future. Now, there's something really important to note here. If you do take from those tanks, most people only put back what they took. Do you put that money back at interest? This is a very important concept that we're going to talk about more as we go. So let's look a little bit deeper into these major capital purchases. So back to wealth transfers, money that you lose either unnecessarily or unknowingly. Some of those transfers are avoidable, while others you can only minimize. And we want to talk about really how to maximize all those dollars that flow in, avoid where we can, and minimize where we can. A couple of key principles to understand is that you finance everything that you buy. You are either paying interest or you give up the ability to earn interest. That's very important. We're going to talk about that more as we go. The second is that every dollar that you do not save is going to be consumed by transfers and lifestyle, meaning it's going to be lost in wealth transfers or you're going to use it in your lifestyle. Either way, those are dollars that are gone forever. So when it comes to major capital purchases, it's very important to understand that creates a lot of wealth transfers. For example, if I finance a car today, I may pay interest on that vehicle and ultimately lose the interest and the opportunity cost, like we've already talked about. If I decide to forego that car today to buy it in the future, where am I saving those dollars? You could be foregoing investment growth by saving in a savings account that earns 1%. Maybe you could earn 5% somewhere else. That's 4% opportunity cost. If that account is taxable every year, you're taxed on those dollars, you lose the tax, and you lose the opportunity for those tax dollars to work for you in the future. A lot of wealth transfers occur in how you make purchases. Now let me go into one example here. Let's stick with that car purchase. Financing your car has a couple of areas to note. When you purchase a car, you finance a car, you have the debt on that car or the principal, you have the interest that you pay on that loan, and you have the opportunity cost on that interest. So if you finance a $30,000 car at 6% over 60 payments or 5 years, your car payments will ultimately be $579 a month, and you'll pay $34,799 in total payments. The total interest will be $4,799. So how much of that wealth is transferred away? Well, what's that $4,799 worth at 5%? Well, in 5 years, it's going to be worth $6,125, and in 50 years, it'll be worth $55,033. So if you buy that car that same way from today through 50 years, you'll have transferred away $232,000 of that overall wealth potential. So that's a major wealth transfer, $232,000 worth. So that's just an example of a wealth transfer when it comes to buying a car. Credit cards have the same thing. A $10,000 credit card balance, 18% interest rate and a 5% return means that today you're going to pay $1,972 in interest, and in 40 years you're going to have paid $78,000, while the total wealth transfer is $238,000. So a $10,000 purchase done wrong can ultimately cost over $230,000 by simply handling that incorrectly. Very, very expensive purchase there. So when it comes to making a purchase, there's a couple more things to keep in mind. Before you outlay any cash or any capital for any purchase, you've got to consider the cost and also the opportunity cost. What are those dollars worth to me somewhere else? It's not just what you pay for, but it's also how you pay for it that can make all the difference. So how to buy, borrow, and pay for major capital purchases. We're going to start getting into the different ways that you can actually make those purchases and figure out which way is most efficient in overall wealth creation. So let's talk about what the first individual that we all know very well, the debtor. They essentially work to spend money. The debtor is someone who does not save money, that earns no interest and pays interest to someone else. They are on the poor side of interest. We all know this scenario. We all know that debt is not what, a pleasant experience, and we're always taught not to go into debt. We're always taught to be the saver. Now, the saver is someone that saves. So let's talk about. So let's talk about how to buy, borrow, and pay for major capital purchases. We're going to talk about three particular individuals. The first we're going to talk about is the debtor. The debtor is someone that works to spend. They don't save money. They tend to pay a lot of interest, and they earn no interest. The second individual is the saver, someone who saves and doesn't like to pay interest, so they avoid paying interest. Typically, the saver is someone that saves up and then pays cash for those purchases. These two individuals we're very familiar with. But the third I want to introduce you to is one that we call the wealth creator. So this is someone who saves money, earns compound interest, and collateralizes their purchases to overall increase efficiency. So let's take a look at these a little bit more in depth. This black line represents somewhat of a zero balance. So the debtor is someone who essentially borrows today, puts themselves in the negative, and then works their way back to zero. Once they get back to zero, they borrow again, and they pay it back, borrow again, and pay it back. This is why we say they work to spend. They're always spending, they're always on the poor side of interest, and they always pay interest. The saver, on the other hand, is on the top of that zero balance, but they're still governed by the zero balance. They save, pay cash, put themselves back to zero, they save, they pay cash, and they do it all over again. Obviously, they save interest dollars, but they may not be employing the most efficient strategy. So let's take a look at the wealth creator. So the wealth creator is someone who understands the value of compounding interest. They don't want to interrupt that compound interest no matter who uses those dollars. So when they need to make a purchase, they collateralize that purchase, meaning use someone else's money, putting up their money as collateral. They borrow, they pay back, they borrow, they pay back, and ultimately create a lot more wealth by keeping that compounding growing. They don't interrupt that or reset that compound interest by depleting their resources. So let's look at these a little bit more in depth. The first one is consumer debt. Let's look at a couple of the problems with consumer debt. It's an obligation on future earnings. You lose the capital to purchases and the financing costs forever and the opportunity cost on those dollars. You're in debt to someone else and you basically have no control. Consumer debt is one of the most inefficient purchasing strategies. You lose interest, you lose opportunity cost, and you really have nothing working for you. So what are we taught to do? We know debt or being someone who's always in debt is not the solution, but we're always taught to pay cash. So let's take an example of paying cash. Let's say you save $5,000 into an account that's earning 5%, and we're going to look at a 30-year period. Over that 30-year period, you could potentially earn $353,000 of future dollars. If over that period you drain that account 5 times every 4 years, meaning you save up, you make a purchase, you save up again, you make a purchase, and you do that 5 times. Over that 30-year period, you're going to have $71,000. You've simply reset the compounding every time you made that purchase and ultimately cost yourself $282,000 of future wealth. This is a big problem. So consider this. What if you could make the purchase without emptying the tank? This would allow your private capital reserve to continue to employ the benefits of compounding, meaning you wouldn't reset that compound growth. So the question becomes, if I don't use my capital, whose do I use? You collateralize a loan from a financial institution, and you secure the loan by pledging a portion of your private reserve. So we have our private reserve tank, and it's continuously compounding. Again, we don't want to interrupt that compounding, so we don't want to empty that tank. So let's say we need to make a purchase of a car, a wedding, education, whatever that major capital purchase is. We seek out a financial institution to offer us a loan, and we pledge a portion of our private reserve as collateral. We don't use those dollars, we pledge it as collateral. Now keep in mind, some purchases, like a car, you won't need to offer up collateral. The car will act as collateral for that purchase, meaning you'll still have all of the private reserve available for collateral. What we want to do is take a loan from this financial institution that offers us a loan that we pay back with interest and principal payments. So how would this purchase look? Let's take an example of an account that has $30,000 in it. So your private reserve account has $30,000, it's earning 5%. Over a 10-year period, we'll look at a 10-year window, you'll earn $19,410 in interest with a final balance of $49,410. So we want to pledge this $30,000 as collateral for our purchase. So we get a loan from a financial institution for $30,000 to make that purchase, and over a 10-year period, that'll be $318 monthly payments. The total interest that we'll pay over that period is $8,184. Now, keep in mind, it's not just what interest you pay, but what that interest could also earn. So the interest at interest, or the interest plus opportunity cost, is $11,385. So you've paid $19,410, you've earned $19,410 in interest, but you've paid $11,385 in total interest and opportunity cost. Now keep in mind there's principal as well. So the principal at interest is $38,025. So the total cash outlay or opportunity cost is going to be $49,410 on this purchase. Now this is where we have to consider human nature, because obviously $49,000 earned and $49,410 is about the equivalent of paying cash. But the problem with paying cash is that when we pay cash, we never replenish those dollars at interest. Think about it. When you pay cash for a car, do you ever replenish your funds plus interest? No. We refill our tanks as much as we can in order to make our next purchase. We miss out on that compound growth because we give that compound growth up. We don't value our dollars like we do other people's money. So collateral capacity. This is the amount of money that you have in your reserve account that can be collateralized. This is the dollars that we can use to make our purchases. So there's three ways to increase your capacity. You can contribute to your private reserve, you can have internal growth inside or compounding growth inside your private reserve, or you can have lien reduction. When you pay off loans, obviously you're going to have more collateral to utilize inside that private reserve. So now that we understand what we're trying to accomplish, meaning having our money compounding, using other people's money, the question becomes, well, what do I need in an account or a private reserve in order to employ this strategy? What are the characteristics that I need, and what are the characteristics that are just ideal? So let's make a list here. So the first is going to be tax advantages. We're going to want an account that we don't lose money to wealth transfers. We want tax-deferred growth, and we want tax-free distribution. The more we pay in taxes unnecessarily, the more wealth transfers we have and the less we have in the future. Competitive returns on that compound growth. We want our compounding to be very valuable. We want to be able to put in high amounts of money, as much as we need to, and we want to potentially deduct those contributions as well. In order to utilize this strategy, we're going to need the ability to collateralize this private reserve account, so collateral opportunities. Another ideal characteristic would be a safe harbor, a safe place. Another would be no loss provisions, meaning guarantees, knowing that our money will never be lost. The next one would be guaranteed loan option, an opportunity to borrow whenever we need to. If we're going to contribute and add dollars to this private reserve, we can't have those dollars be used solely based on what money we're making, what our credit's like, and we need a guaranteed loan option so that we can use those for emergency situations or any situation. Unstructured loan payments. This is important. We need the ability to structure our loan payments around our cash flows. If we take a large loan and we're restricted to a 5-year window, for example, those payments might be too high. Whereas if we had the ability to pay it over 20 years, those might fit our monthly cash flows. So unstructured loan payments is very important. Liquidity use and control. This is very important as well. Ability to access dollars for what we need when we need them. And other added benefits you could even compare as well. So there are a lot of accounts that could potentially work as a private reserve. Some are going to be better than others, but let's take a look at what accounts might work. So there's going to be potentially a savings account, certificate of deposit, 401k, margin account on a stock portfolio, real estate equity with HELOC, and potentially permanent life insurance. So let's just look at maybe 2 or 3 of these. A savings account. This is a natural one to think about because it's completely liquid. So here's what you're going to get. You're going to see highlighted on the right here all of the benefits of the one we've chosen. So our savings account or our money market. It's not going to have tax-deferred growth because it's going to have tax-free distribution, and that's pretty simple because you pay the taxes every year and they're taxed before they go in. It's not going to be competitive returns. In fact, this is going to be one of our biggest issues. Saving for our next car. If we're earning 1%, that's a wealth transfer because we might be able to earn more somewhere else. So interest rates are just incredibly low. High contributions, put in as much as you want. Collateral opportunities could potentially be collateralized even though it's up to the bank's discretion. There's no guarantee there. It is safe. There are no loss provisions, but there's no guaranteed loan option. You could potentially collateralize it like we talked about, but that's not a guaranteed loan option. And you certainly don't have unstructured loan payments. That'll be up to the bank when the loan comes. Liquidity use and control, access it whenever, but there's no deductible contributions either. So potentially could work. May not be the most efficient place to do so, but it could potentially work. So let's look at the 401k. A lot of people have 401k plans. So on the right, you'll see the benefits. There's 4 benefits in the 401k out of all of the benefits. There's tax-deferred growth, competitive return, potentially, some potentially other benefits, and then deductible contributions. The problem with the 401k is that you're not going to be able to have, you're not going to be able to borrow money, you're not going to be able to collateralize it, you're not going to be able to structure payments. Really, the only way you're going to be able to use that money is if you need to, or if you're over 59 and a half years old. Either you can prove to them that you need it, even then the loans will be in a 5-year period, and you're going to be maxed out in a lot of different ways. In addition to that, if you do borrow or you do use those dollars early, you could trigger a penalty of 10% and ultimately cost you more in wealth transfers by penalties and fees. Well, so let's look at the permanent life insurance. A lot of you already know that most people that use this strategy use life insurance, and here's why. The benefits on the right highlight. Let's talk about those. A permanent life insurance policy, and to clarify, we're not talking about a traditional permanent life insurance policy. We're talking about a highly specialized and correctly structured permanent life insurance policy. This is far different than a traditional life insurance policy. But doing it right, these are the benefits you'll get. Tax-deferred growth and tax-free distribution. Going to eliminate a lot of wealth transfers by those tax advantages. You're going to have competitive returns. In fact, we see studies all the time where returns are anywhere from 4.5% to 6.5%. And again, those are tax-free. Very competitive, but also very safe. High contributions, no limits on what you can put in. Some additional benefits would be a death benefit. Another benefit would be some asset protection depending on where you live and how you use it. Collateral opportunities. Talk a little bit more about that, but there are guaranteed loan options inside of an insurance policy. If you have cash value, you can collateralize it. It's safe. It's one of the safest places to have money. It's no surprise that banks and large corporations have been putting money in life insurance for years because it's some of the safest money that they have. No loss provisions. It's extremely safe. Guaranteed loan option. Anytime you want a loan, no questions asked. You don't do a credit check. There's no income verification. As long as the collateral is there, they will issue you a loan. And those loans are unstructured. Unstructured loan payments, meaning you pay it back as slow or as fast as you want. No questions asked. Liquidity use and control. You can use this money for anything and anything. The only thing that you wouldn't have as far as benefits go are deductible contributions. Instead of paying the taxes later in a potentially higher tax bracket, we get rid of them today by putting them into the life insurance contract. So life insurance can be very, very valuable. And to kind of show you our scorecard, this lines up all of the different possibilities. PLI is permanent life insurance. You have all of these benefits, -1. You can look at these as you go. HELOC, CD, money market, 401k. The reason that a lot of people for private banking use life insurance is very simple. Its advantages exceed most any other place out there. So let's look at how permanent life insurance acts as a private reserve. Let's fit it into our model. So policy cash value acts as our private reserve account. That is what we borrow against. That is our collateral. It continues to compound and compounds very well. One thing to keep in mind with life insurance is there's going to be a little bit held on reserve. That depends on what company you use, but most policies have 90% plus available in cash value immediately. The reason that there is a reserve is because of the death benefit protection. It's kind of a shield, if you will. It protects you from losses and can ultimately pay a high yield if something were to happen. So let's say we need to make our purchase. We'll go back to our car or wedding or of education costs. We borrow from the insurance company, we use them as our financial institution, and we offer a lien on our policy cash value. They issue us an interest-only loan that we pay back with unstructured payments, as fast or as slow as we want. Now, the insurance company acts as a great mediator there. It always offers a loan, guaranteed loan options. But that doesn't mean that we can't go elsewhere and shop for better opportunities. Right now, we're in a very low interest rate environment. Home loans have extremely low rates, probably lower than an insurance company is going to offer. So taking advantage of that is a great opportunity. That can change over time. In fact, in the 80s, a guy named Nelson Nash was paying 21.5% on property that he owned. He realized by borrowing from his life insurance policy, he could get loans at 5, 6, and 8%, saving him thousands and thousands of dollars every month, and ultimately saved his business. So you have the option of going anywhere you want for loans, while the insurance company is always offering very, very competitive loans. So that's how that fits into our strategy. Permanent life insurance, when designed and utilized properly, can provide stable growth, cash value collateralization, guaranteed loan access, no annual tax on growth, and death benefits. Additional benefits are available with additional policy riders that we use to enhance the value of the policy. So let's take a look at this as kind of an example here of paying cash versus using a private or your permanent life insurance policy as a private reserve. So let's say you save $30,000 a year into a policy over the next 5 years, and we're going to look at purchasing something in year 6. We'll say we borrow $50,000, and that payment's going to be $13,577 over 4 years. So over 25 years, at the end of that 25-year period, we're going to have $804,000 death benefit and $396,000 in cash value. Okay. If, however, we decide to pay cash, we're going to use the same statistics, but the cash account rate of return in a savings account or a money market is probably going to be around 1%. But instead of saying 1, we'll go ahead and say 2, just to show the most competitive scenario. We'll assume a 30% tax bracket, and we won't even look at the term cost. The term cost would eliminate some of the future value. So the purchase will be $50,000, same payments over 4 years. The result at year 25 is going to be no death benefit to show and cash account value at $209,000. This is a huge difference. Now, if they were earning more, even if they were earning 3%, the value is huge. Now, if we had an annual term cost of $300 a year, we could go on and on about the differences here, but we decrease our future value there as well. So paying cash can have a lot worse effect simply because of the wealth transfers that we give up, the opportunity to earn more money, the taxes, all of those other scenarios or wealth transfers start to occur and decrease our overall value. Now, before I wrap up, I want to talk about one last thing. A lot of people ask me about, what's the rate of return, and what if I can earn a better rate of return? So here's the first thing and the main thing to keep in mind here. This is your private reserve account. This is your foundation, your private banking system. Let me give you an example. Last year I bought 2 real estate properties. I bought them through my policies, and the reason I did that is because I get more value for my dollars there. My dollars continue to compound. I pay interest on those loans. I get a tax deduction for that. I earn income from those rental properties. I also earn appreciation. When I make purchases that actually appreciate and create value, I purchase investments through the private banking system, I create even more value. So keep that in mind. If you're earning 4 or 5 or 6% inside of your insurance policy, and that's just not enough, and you have an opportunity to earn greater, that is okay. Borrow against those dollars and put those dollars to better use. So I'm going to kind of turn this over to questions now. But before I do, after this is over, and we're gonna rush through these questions a little bit because I want to get you onto the next page and get you signed up for the next webinar. But our next webinar is going to be talking about more of an in-depth analysis on how permanent life insurance works and how it's structured. In fact, I think I'm going to probably have, and I just as I'm glancing through the questions, there's going to be some that deal with that. That next webinar is going to go in depth on those things. So I'm going to redirect you to that page where you can sign up for that. On that page will be all my contact info as well. You're welcome to email me, contact me with any questions. A lot of you at this point are probably ready to see what this looks like and see if this is something that fits you. It may or may not, but let's talk about it. Give me a call, send me an email, and we'll talk about maybe some more specific questions that you might have. Feel free to do so. So let's get into a couple of these questions here. And keep in mind, some of these are very specific, so I won't be talking about those. But if you do have specific questions, feel free to give me a call or shoot me an email. But first one we have is what are loan rates from the insurance company? It's a good question. Loan rates are based on actually the earnings of the cash value. So they're based on each other. So for example, if I'm earning 5 or 6% inside of my cash value, then I'm probably paying 4.5% to 5.5% in interest. So they're usually a little bit lower than the dividends that will come every year. That being said, interest rates right now are around 5%. They're very competitive. In our environment right now, they might not be the most competitive, but as interest rates go up, they will be more and more competitive. So this is an adaptable strategy. Is one of the best strategies for changing environments. As interest rates change, you're not subject to what banks, Federal Reserve, all of those different institutions are subject to. Your loan rates are very conservative based on the growth inside of that policy. Second question, does this work with all insurance policies? And then there's another one too about insurance companies, which insurance companies work best. I'm going to kind of combine those. It works with a lot of policies. Most policies offer an opportunity to borrow. But keep in mind, many policies and most policies are not specifically designed like we're talking about. We're talking about a very highly specific design that allows for cash value and added growth inside of these policies. So that's very important. There's only a handful of companies, to kind of answer that question, that produce some of the best results for this strategy. If you want to talk about what companies work best and all those sort of things, we work with as many companies as you can think of, but we'll kind of look for the best policy based on those situations. That's kind of where we come in handy. Another something to focus on here is when it comes to these policies is that they can change over time to create more value. That's kind of where our expertise comes in and how to structure, handle, and implement this strategy. So give us a call if you have any questions. Thanks. This is a lot of new information. So does this mean does this mean I need a new life insurance policy? No, not necessarily. Life insurance policies often get better over time. So if you're into a policy many years, the last thing you want to do is get rid of that and start a new one. It can be very efficient, could work very well. It just depends on what company, what provisions, what things you have inside that policy. So I'm certainly open to analyzing that, helping you to make that decision. If you have something that works, there's no way we're going to touch it. The last thing you want to do is start all over if you already have something going. So give us a call. Let me know what you have and what you're doing, and we'll talk about the best solutions. Aren't there limits on how much you can put in? Isn't there a MEC? Yeah, so the MEC is, I'm guessing you've heard that online or you've read that in one of the books. That's what we're going to talk about in our next webinar. We're going to go in depth about that. But yes, there are limitations, but it's not a dollar amount. It's based on how the policy is structured. So again, that is based on how we structure the policy. We'll talk about how that works, but really there's no limit to how much we can put in. The question is how we put that in, and that's where we come in handy. I read a book that said I was borrowing my own money, but you say that okay, let's see. I read a book that said I was borrowing my own money, but you say I'm borrowing from the insurance company. Which one is it? Well, that's a lot of people talk about borrowing from yourself. The reason that is because you earn about what you pay. So they talk about kind of paying yourself, but you're not. I mean, you are writing a check to the insurance company when you make those loan repayments. So they're not going to you, but this is to your benefit. I mean, if you were borrowing really from yourself and you went and invested that money, you would lose a tax write-off that you're going to get by borrowing from the insurance company. So keep in mind these insurance companies are not designed for profit. The ones we use anyway, they're mutual. They're insurance companies that are designed to benefit policy holders. There's not there's not stockholders. There's not profits that are being siphoned off to different people. Profits go back to policy holders. Got another question here about mutual companies. So same thing. We do work with mutual companies. Those are the best ones to use. Again, we've done all the research that you could think of to figure out which policies work best and which companies work best. So I'm going to kind of cut it there. If you have any other questions, I know we've got some specific ones here. We can answer any of those if you want to. But give us a call. Give me a call or shoot me an email, and I can answer any questions you have. Again, on the next page, all that information will be there. Thanks for joining me on the webinar. Let me know if you have any questions, and definitely sign up for our next one if you haven't already. It's going to be a good one. Have a good one. Thanks.